Okay, in the last session, we talked about the major character of market behavior, namely that markets are fractal in nature, which means that they behave in similar patterns from the largest time frames of years out all the way to the smallest time frames of several minutes. They always show the same types of patterns. And the second thing is how they move in trends and then balances, in trends and then balances. All right? And so those happen to be two of the major laws that govern market behavior. All right? Now, there could be many laws that we can talk about, but what we've done in our own trading is identify the 10 major laws that we feel explain market behavior in the best manner possible, but are also practical to be able to be used later to take advantage of market behavior. Right? Understanding markets deeply with some complex laws that don't give you a practical application would not be very helpful. So what we care about is teaching you about the laws that give you a deep understanding of market behavior while also being able to lend themselves very well to a practical application so you can use them in your trading. Alright? So this is law number 1, the markets are fractal in nature. Law number 2, as we've discussed, is that in any given time frame, the markets can either be trending or balancing. And now we'll go on to discuss the rest of the laws. And so let's start with law number 3. Price moves in a series of thrusts and corrections. Alright? So now we know from law number 2 that the markets are either trending or balancing. But we haven't discussed yet within each of those phases, how do prices actually move? What is the character of their behavior when they're moving? Because prices don't move in a straight line, up or down. No matter how much it may seem like it if you're zoomed out, once you take a deeper look at the markets, you'll see that they always move in a series of thrusts and corrections. And so let's take a look at that right now. Okay, here we're looking at a candlestick chart of the E-mini S&P 500 futures. Okay, now just as a general note, all of these principles and laws that we're going to be discussing apply to any market. It can be the S&P 500 futures, it can be commodity futures, it can be stocks, it can be ETFs, Forex, anything will work, right? But we're talking about the S&P 500 futures in this example. Now, this is a candlestick chart of market movement. As you see, in this day, the market opened here, then it went on to move down in the morning hours, right? Hit a reversal, and then trend back up throughout most of the day, all right? Now, looking at this, which is a 5-minute candlestick chart, each one of these bars is 5 minutes. Looking at this, so the market opened here, made a little up move, then made a thrust down, right? Had a small correction where it reversed some of this down movement. Then a big thrust down, stops here, corrects up, another thrust down, okay? Then the market reverses completely, thrust up, small correction, thrust up, small correction, same thing, correction, another thrust up, okay? This is how markets move. They don't just move pure straight lines. There's always this back and forth behavior. Now sometimes these corrections happen like this, where you have what's called, you reach a swing high, and you just correct down, hit a swing low, and then back up to a new swing high and another correction. And sometimes the corrections happen sideways, for instance, like in this example. Here we move up, thrust, reach a swing high, and just kind of move sideways, i.e. we balance, and then we thrust up again. Okay? Now the thing is that if we were to look inside this balance area right here, within this trending up move, we would find that the prices within this little area are still moving the exact same as this. They're making thrusts, pullbacks, thrusts, and pullbacks. Alright? And even mini balance areas potentially within that. So this is the nature of price movement, and this is law number 3. You just have to realize that prices never move straight up and never move straight down. And so we move on to law number 4, which is that price discounts all information efficiently, but not perfectly. Now this is probably the most controversial and least understood area of all the markets. The most debates happen about this law. You have one camp, which is the efficient market theorists. Okay? The people, basically, the analysts and the economics teachers and the Nobel Prize laureates that say the markets are perfectly random and that price instantly discounts all available information out there. So all analyst recommendations, all human nature, fears and hopes, all real supply and demand fundamentals, every opinion, rumor, and news is all instantly in the price. And they say that you can never take advantage of price movements because it's all perfectly efficient. Anything that's ever known about a stock or a futures market or any type of market is instantly reflected in its price. Right? That's what they say. Well, if that were true, then it would be impossible to make money consistently from the markets as traders. And I speak from personal experience to tell you that it's not true. You can definitely make consistent money as a trader, and many have in the past, right? But the reality is that markets are not the other extreme. They're not completely inefficient, okay? So what this means is that prices do discount all the information out there, and they do it very quickly, but it's not perfectly efficient, and oftentimes markets go too far in one direction or the other. And this is because they're, again, efficient but not perfect. See, what the random market theorists, what the people who believe that the markets are perfectly efficient have gotten wrong, is that they view market participants as perfectly rational beings. That's, the crux of all modern economics. But that has been proven to be wrong. And like we discussed before, human beings have psychological traits and emotional patterns that affect their behavior. They're not perfectly rational. And because of this, when they participate in the markets and they cause prices to move, sometimes they cause them to move too far in one direction or to the other. Sometimes their fear overtakes them and prices drop far too low as compared to what their real value should be. Now, eventually, they will snap back to the correct value, right? And so that's why they're efficient. They won't stay at a wrong value for too long. But the key is they're not perfect, they're not instant. Now, this has a couple of different takeaways from it. One is because they're extremely quick, it makes no sense for you to try to trade on rumors and things of that sort. If the rumor's out there, it's already been discounted into the price very quickly. And even if it wasn't perfect, it was efficient enough to move to the correct value, so you're not going to be able to take advantage of a rumor or something that an analyst says or an opinion, especially if you read it in the news, because it's already been out there. Once you read it, it's out, the price has already made the move to adjust for it. Okay? On the other hand, many times there will be overreactions in the market, right? People will get too emotional. The retail crowd would get too fearful, too greedy, and those end up being great opportunities for professionals who do understand the market, right? For people who have taken time to study it like you're doing now, to take advantage of those price movements. Okay, and with that we get to law number 5, which is that trends start from balance areas or after major climaxes. Now it's really important to understand how trends begin, how they form. Okay? And there really are two major ways in which they form. And so let's go into a price chart and give examples of this. And so here we're looking at the E-mini S&P 500 futures market. Alright, this is again a 5-minute chart, and once again these concepts apply to any market that you could trade, any futures contract or any other type of market. Alright, so we said that trends start most often from balance areas, alright, or after major climaxes. So let's take an example of the first one. If you see here, this is a major balance area. We were going sideways for many days on end. Okay? Every time we retest higher, it gets rejected, it comes back lower, and it's just building value at this area. Alright? Now, we want to look at how and when does a trend start. Okay? So now, within this, if we zoom in a bit here, within this balance area, we see that there are some sharp moves. This is a sharp down move. This was a sharp up move. Okay? And those all look like they could be a start of a trend, right? Now, on the smallest of time frames, so this is a 5 minute. Now, if we were to go down to a 1 minute time frame and look maybe at a 1 minute time frame, that was considered a trend and you could have traded that. But you have to look at the context of trends and balances from their respective time frames. Okay? So now we're zooming out to, instead of within 1 day, and this is a strong trending move within this day, we're trying to look at, okay, what is a trend, right? What is a trending move on this time frame that we're looking at? And we can analyze this from any time frame, but I'm just choosing the 5 minute to give an example. Okay, so the 5 minute time frame shows several days of market action here, all beside each other. And so this was the trading range, the balance area, right? And we have all these sharp moves within it that look like, could these be new, bigger trends or not? Well, if you understand this law that trends usually start from balance areas, it makes it much easier to kind of gauge when a real trend might be starting, right? And if we zoom back out here and we look at this balance area, we can be expecting that no real trend is going to start until we reject this balance area and move out of it, okay, to one way, either down or up. In this case, we do move up. We opened here and we just keep skyrocketing up. So this was the start of a new trend on this time frame. And it started from a move out of this balance area, a rejection of value. All right? So this is one of the ways that trends can start. The other way is what's called when we hit a major climax. Okay? So now let's take a look at that. Okay, staying on the same time frame for consistency's purpose. So we're still looking at the S&P 500 futures on a 5 minute time frame. Let's take a look at how the market can change trends with a climax. Okay, so here the market was moving up higher and higher and higher, trending for many days on end. Okay, and then we hit this one day where it really just takes off and just momentum is fast and it's high and it's on large volume and it's moving, and it hits this climax, this peak in movement right here. Okay, and all of a sudden it just reverses and goes back down. It doesn't even take the time to really balance up there in any major way. It just has what's called a V-shaped reversal. Look, it's like a V that's upside down, and it just shoots up, climaxes, and is all the way back down. Okay, now that is another way that a trend can begin, is after this climax. Now, why does a trend begin after the climax? Okay, a climax is a state when prices have moved too far in one direction. Remember we talked about inefficiency? Well, that's one sign of inefficiency. So buyers, after this huge up move had already occurred, buyers got really aggressive here. Okay, and they were very excited about the prospect of the market. They believed that value should even be higher than this, right? And quite possibly they were greedy and acting emotionally, and they were buying it up. Most of the time, it's usually the retail crowd doing this, the uninformed buying at these high prices, and the professionals and the major big hedge funds and all that, they're selling against them. But regardless, these people got aggressive and started buying really fast, really aggressively up here. And it resulted in a climax where now we had gotten to a point where the price had gone too high, too far away from its true value, and the sellers came in, right? And they perceived this to be too high and they started selling aggressively. And these buyers, what ends up happening, the reason why it ends up creating a new trend the other way, is these buyers that have been buying now are stuck with these long positions. They're stuck with all the stuff that they bought, and now they're forced to sell as the market goes back down, and this creates a new thrust downwards as the market tries to see if now value should be even lower. And for a real trend to occur, there must be also other fundamental reasons why it's moving in that direction. But the real thrust happens after this climax. So if you'll notice, we're going back to the original framework, correct? We're always looking at, first, what is happening with regards to value, and how is the market moving, and where is it establishing the real value? And second, what about the market players? What about their psychology? And whenever you see these major climaxes after a trend that is already going up quite a bit, that often could be the tell that it's going to reverse, because now it has just gone too high, it has run its course, and the laggards, The people who don't really understand the markets are now just buying on hope, not buying on real fundamentals, right? They're buying on greed. This up move has already taken place. Now, two things to note, okay? In terms of the frequency of how trends really occur. A lot of people will look at this and it just seems so dramatic. You see this high up move, and it looks like a nice way for trends to start. And you might be tempted to always go look for when are we going to see a climax. Does that mean that's a good place to get into a trend the other way? Well, let me just give you a note of caution just from pure experience and from knowing a lot of other professional traders who have studied these things. And it's the fact that this happens the minority of the time. Okay? The minority of the time, trends start after a climax. The majority of the time, they start after a balance area. Okay, after there's been some kind of balance, and then they break out of that balance. That's the majority of the time in terms of market behavior. And the second thing to note is that you have to be flexible in this. Okay, these are broad frameworks and broad laws to kind of help you make sense of things, but never take anything too literally and believe that it's always going to be this way. You know, trends can basically start at any time, even if there's no major balance area and even if there is no climax. But what we need to do to understand market behavior is look at what's common, what's usual, right? And you look at those instances and you try to extrapolate from that. There's always going to be exceptions. You know, don't go now looking at the market and saying, oh, how did this trending move start if there was no climax or no balance? You know, the markets are extremely complex. These are broad frameworks that we use just to help us make sense of them in general. And when you're looking at balance areas or climaxes, you know, don't be looking for the ideal. The one I showed was very nicely, perfectly sideways, but there are going to be other ones that where the highs and lows don't perfectly match. You know, you have to look at things in approximations. There's nothing that's exactly precise in the markets, and that's where traders often fail. They look for the exact precise. You know, they're looking at a certain high and is it, oh, did it touch it to the tick? That's not what matters. What matters is just having a general understanding of why something is happening and how it's happening, and having these broad frameworks to kind of structure how you think about it, and then that'll help you put into practice the strategies and the tactics that we'll be teaching.